Every year, Americans overpay billions in taxes, not because the law requires it, but because nobody told them what they could deduct. The IRS is not going to call you and say, "Hey, you forgot to claim this." Today I'm going to show you the tax deductions that most regular Americans completely miss. And some of them could save you hundreds, even thousands of dollars. I'm not talking about shady loopholes, I'm talking about 100% legal deductions that are sitting right there in the tax code, waiting for you to claim them. So, grab a pen, because after this video, your next tax return is going to look very different. Before we get into the deductions, you need to understand one thing. There are two ways to file your taxes: standard deduction or itemized deduction. In 2024, the standard deduction is $14,600 for single filers and $29,200 for married couples filing jointly. If your total deductions are higher than these numbers, you should itemize, and that's where most people leave money on the table. But here's the thing. Even if you take the standard deduction, some of the deductions I'm about to show you are above the line, meaning you can claim them no matter what. These are called adjustments to income, and they reduce your taxable income before you even choose standard or itemized. Okay, now let's get into the actual deductions. I promise, every single one of these is real, legal, and most people have no idea about them. Deduction number 1, the home office deduction. And this one shocks people every single time. If you work from home even part-time and you use a dedicated space only for work, you may be able to deduct a portion of your rent, mortgage, utilities, and internet. The IRS has a simplified method. You just multiply the square footage of your workspace by $5 up to 300 square feet, giving you a maximum of $1,500 deduction. If you're a freelancer, a self-employed person, or a small business owner, this deduction is basically free money you've been skipping. The key rule: the space must be used regularly and exclusively for business, not your kitchen table where you also eat dinner. Most people skip this because they think it'll trigger an audit, but that's an outdated fear, especially for self-employed people who file Schedule C. Deduction number 2, student loan interest, and this one applies to millions of Americans who have no idea about it. You can deduct up to $2,500 of student loan interest you paid during the year, and this is an above-the-line deduction, meaning anyone can claim it. You don't even need to itemize, this comes straight off your adjusted gross income before anything else. The only catch: this phases out if you earn above $75,000 as a single filer or $155,000 for married couples. Your loan servicer sends you a Form 1098-E every year showing exactly how much interest you paid. Just plug that number in. Most people just pay their student loans and forget they never check how much of that payment was interest, and they walk away leaving $2,500 on the table. Deduction number 3, self-employed health insurance. And if you're your own boss, this one is massive. If you pay for your own health insurance, including dental and vision, you can deduct 100% of those premiums from your taxable income. The average American pays over $5,000 a year in individual health insurance premiums. That's $5,000 you could be deducting. And most self-employed people miss this entirely. This deduction also extends to your spouse and your dependents, so a family health plan could mean a much larger deduction. The only condition: you cannot claim this if you were eligible for health insurance through an employer, even if you didn't take it. Deduction number 4, retirement account contributions. And this might be the most powerful tax deduction available to regular Americans. If you contribute to a traditional IRA, you can deduct up to $7,000 per year or $8,000 if you're 50 or older. That means if you're in the 22% tax bracket and you max out your IRA, you're saving $1,540 in taxes for money you were going to save anyway. If you're self-employed, it gets even better. A SEP IRA lets you contribute up to 25% of your net self-employment income, up to $69,000 in 2024. The trick most people miss: you have until tax day, April 15, to make IRA contributions for the previous year, so you can literally lower last year's taxes right now. And yes, this is completely above board. The government wants you to save for retirement, so they literally reward you with lower taxes for doing it. Deduction number 5, educator expenses. And this one is for every teacher who spent their own money on classroom supplies. Teachers, instructors, counselors, principals, and aides can deduct up to $300 in out-of-pocket classroom expenses, $600 if both spouses are educators. Books, supplies, COVID protective items, software, computer equipment used in the classroom, all of it qualifies. This sounds small, but it's above the line, and considering the average teacher spends $750 of their own money on supplies, this is at minimum partial relief. Deduction number 6, medical expenses. And this one has a threshold most people don't know about. You can deduct medical expenses that exceed 7.5% of your adjusted gross income. So, if you earn $60,000, anything above $4,500 in medical costs is deductible. This includes doctor visits, prescriptions, dental work, glasses, mental health therapy, hospital stays, and even mileage driving to medical appointments. The big one people miss: long-term care insurance premiums are fully deductible as a medical expense, and as the population ages, this matters more every year. If you had a major medical year surgery, cancer treatment, chronic illness, you absolutely need to tally up every expense because the savings can be enormous. Deduction number 7, charitable donations. And there's a version of this even non-itemizers can sometimes use. If you itemize, cash donations to qualified charities are deductible up to 60% of your adjusted gross income. That's a massive ceiling. Non-cash donations count to clothes to Goodwill, furniture to Habitat for Humanity, a car donation. All of these have fair market value that's deductible. The mistake people make: they donate but never get a receipt, and without documentation, the IRS won't allow the deduction. Rule of thumb: any single donation over $250 requires a written acknowledgement from the charity. Always ask for it on the spot. Deduction number 8, state and local taxes, known as the SALT deduction, and this one confuses a lot of people. If you itemize, you can deduct up to $10,000 in state income taxes, local taxes, and property taxes combined. If you own a home and live in a high-tax state like California, New York, or New Jersey, this cap matters a lot, but it's still $10,000 back in your pocket if you qualify. For people in lower tax states, you might easily stay under the cap, and every dollar of property tax you paid is potentially deductible. Deduction number 9, job search expenses. And almost nobody claims this one. If you're looking for a job in your current field, expenses like resume printing, career coaching, job placement agency fees, and travel to interviews can be deductible. This only applies if you're searching in the same profession. You're currently in a career change from scratch doesn't qualify. Moving expenses are deductible only for active military members relocating on orders, but if that's you, 100% of your moving costs qualify. Deduction number 10. And this one is technically a tax credit, which is even better than a deduction. A deduction lowers your taxable income, but a tax credit directly reduces your tax bill, dollar for dollar. It's far more powerful. The Energy Efficient Home Improvement Credit lets you claim 30% back on solar panels, energy-efficient windows, doors, insulation, and heat pumps installed in your home. In 2024, this credit has no lifetime cap for many improvements, meaning you could claim it year after year as you upgrade your home. The EV tax credit gives up to $7,500 off your federal taxes when you buy a new qualifying electric vehicle, or up to $4,000 for a used EV. Deduction number 11, child and dependent care credit. And working parents miss this constantly. If you pay for childcare so you can work or look for work, you can claim a credit of 20 and 35% of up to $3,000 in care expenses for one child, or $6,000 for 2 or more. This covers daycare, after-school programs, summer day camps, and even a nanny or babysitter as long as it's so you can work. The care provider's tax ID or social security number is required, so always ask your daycare for their EIN, or you could lose the credit entirely. This is separate from the child tax credit, which gives up to $2,000 per qualifying child under 17, and up to $1,600 of that is refundable. Deduction number 12, gambling losses. And yes, this is real. If you report gambling winnings as income, which you're required to do, you can also deduct your gambling losses, but only up to the amount of your winnings. You need to keep a log dates, locations, amounts won and lost, and the IRS takes this seriously, so documentation is everything. The catch: this is an itemized deduction, so it only helps if your total itemized deductions exceed the standard deduction. Now here are 3 bonus deductions that didn't make the main list but are absolutely worth knowing. First, alimony paid under agreements before 2019 is still deductible for the payer, and the recipient must report it as income. Second, if you pay back wages or benefits you received in a prior year, you may be able to deduct or get a credit for that repayment. This is called the claim of right doctrine. Third, investment fees, safe deposit box rentals for investment documents, and financial advisor fees paid from taxable accounts used to be deductible, and some states still allow it. Always check your state return. Here's the bottom line: the tax code is not written for the average person. It's written for people who know where to look. Every deduction I showed you today is 100% legal, fully documented in IRS publications, and used by millions of Americans every year. Just not enough of them. The difference between someone who pays $8,000 in taxes and someone who pays $5,000 is not income, it's knowledge. Before you file this year, or before you pay someone else to file for you, go through this list and see which ones apply to your situation. And if you're using tax software like TurboTax or H&R Block, don't just click through it. Actually read what it's asking. Because those prompts are designed to find these deductions for you if you answer honestly. If this video saved you even one deduction you didn't know about, drop a comment below and tell me which one shocked you the most. I read every single one. Subscribe if you want to keep learning how to keep more of your own money, because nobody is coming to save your finances but you.